So right off the bat, we have a question about, is there a chance the market will crash like it did in 2008?
Uh, well, yeah, there's always a chance of crashes. One thing about crashes, and here's my analogy that I always use. Um, it's usually something that we aren't really thinking about, and that's what makes it a crash. So my analogy is always, you're walking down a dark street and there's this big hedge, and somebody jumps out from behind that hedge, and that's your adrenaline goes, and you get there's a lot of fear, versus kind of knowing that there's somebody behind that hedge and jumping out, not as much fear, right? And so that's what happens most of the time. We weren't thinking about a pandemic, and we had the biggest, fastest 35% downturn in history because it was the person that we didn't know behind the hedge jumping out, right? And so it's always possible to have a downturn, in the sense of, an unknown scenario that we're not really thinking about. Having said that, one of the main catalysts of downturns is rising interest rates, especially by the Federal Reserve, at least in this time frame. So just like I just showed here, the 2008 downturn, you could look back very critically and see that there was an interest rate increase that kind of caused that. And eventually it just gets to be so much that the market ends up selling off. And we're at zero right now, essentially. And there's just some talk about possibly raising rates in 2023. I'm pretty confident right now that the market could do quite well. Is it going to make 20% or 2%? That is a little hard to tell. Is it going to lose 5? Because those things happen all the time, right? Anything up to negative 20% is pretty common. And so, but 2008 specifically, it was 53% on the S&P, roughly 60% on the total stock market here in the US alone. And it was a devastating, scenario with lots of unemployment and all these things. I would be very surprised. Usually that comes in a different scenario. So I would say the odds of that are actually quite low at this point. We could be there in a year, 3 years, 5 years, when things really develop, when unemployment is, a lot lower and those type of things, when the market has just kind of really exhausted itself and the Federal Reserve has raised rates and raised rates and raised rates. That's a fairly common scenario. Again, something can always happen, like a pandemic that we weren't expecting. But yeah, I would say that's, probably a low possibility right now.
So do you feel that like cryptocurrency now, it crashed for 40%,
Yeah.
but you don't think do you think it could still be a possible catalyst in the future? You talked
Well,
about in earlier videos
yeah,
how you speculated with crypto.
yeah, it's actually kind of interesting because one of the issues that I've been trying to watch very closely is to see, because in cryptocurrency there's no regulation, so you can do 100 to 1 leverage. So you can put up $1 and buy $100 worth of cryptocurrency essentially. And so of course, if there's even a little bit of a downturn, you got to sell, or you'll get a margin call. And so, what can happen in those scenarios when a lot of people are borrowing money is they start to sell some of the other things that we own. So, Apple or whatever it is that you like is now being sold off because it's a source of funds to cover those margin calls on the cryptocurrency side. We didn't see that here. So we did, like, literally, from high to low there, that was a pretty big drop, closer to 50%. And we're not seeing the market, fall apart, or we're not seeing big sell-offs. And actually, we've seen just the opposite, that people have come back and I think are buying some of these, genomics, innovative technology, clean energy, those areas that they were buying last year, they're coming back to. And I would suppose, and it's just a guess, because it's very difficult to see, there isn't a lot of transparency what's happening there. You just kind of watch price, and see what happens. But I would suppose you're not seeing a tremendous amount of institutions get involved with leverage, because that when hedge funds get in there and they start using leverage, they're the ones that end up selling off the rest of the stuff in their portfolio, which can cause downturns. If it's individual investors using leverage, they're important, but they're probably not driving the market down. Especially not even recently as much as the Federal Reserve comments are driving the market down. Uh, so yeah, it's something to watch. Have been studying that. That's why I've been looking at those charts that I just showed you. I think it's an interesting area.